Okay, sweet. It's recording. Hello, everyone. Welcome to this segment of Top Down with TCM. I hope everyone's having a good day. And today, my name is Matthew, and I'm going to be talking about why the market seems unbeatable, or in other words, why most active investors don't actually beat the market. To begin, I wanted to preface that this isn't financial advice and it's for educational purposes only. Me or TCM are not liable for anything that happens. And we're basically just here to have a good time and to realize what's going on in the markets. So, as we begin, let's take a look at some statistics. So first, if you take a look at the top left, we see a percentage of US equity funds which underperform the benchmark. And as we can see, as the time goes on, from the short term, from the 1 year short term, all the way up to the 20-year long term, we see that more and more equity funds actually underperform the S&P 500. And also, if we look at the bottom right chart, we see that the average annual returns from 2011 to 2020 for the average hedge fund never overperforms the S&P 500 index and actually drastically underperforms in multiple years during this time frame. And also to add on to this, Warren Buffett actually has slightly underperformed the benchmark for roughly the past 20 years. And this begs the question, are these investors just doing a bad job? Are they not making the right decisions? And how can this be? Because a lot of these financial professionals come from the top financial schools. They went through prestigious programs, worked at very prestigious firms, and have a ton of work experience to back up their resume. However, they're still underperforming. So are they underperforming because of bad decisions and they're just not cut out for the job? Well, the answer might not be so simple. Also, what's even more interesting is that knowing the basics actually puts you ahead of most investors. So knowing the Finance 101 terms, or yeah, Finance 101 concepts, such as diversification, unsystematic versus systematic risk, correlated assets, risk-adjusted return, and overall just basic fundamental analysis actually puts you ahead of most investors. I would estimate roughly 60 to 70% of investors don't even know these types of terms. And if you know these types of terms, you're actually ahead of most. So even though we're ahead of most, why are most active investors not actually overperforming the market? And now we're going to jump into the key reasons why. Actually, never mind. Before I jump into the key reasons why, this is the most important slide, I would say. And if you had to take away just one point from this entire presentation, it's that markets are controlled by people. And to give an example of this, during 2008, when the market crashed, people chalked it up to the housing bubble, chalked it up to subprime loans. And yes, this is backed by the charts and the data, but who actually uses this data? Well, it's people. And when people saw this data, they went to have a mass sell-off. So the markets are controlled by people, and it's overall just a behavioral thing more than an objective standpoint thing. And also the markets, they're societally constructed. They don't really exist in nature. So that's more of a reason why it's controlled by people. So if there's one takeaway you can take away from this is that you should always remember the markets are controlled by people at the end of the day. Now, the first reason why most active investors fail to overperform an index such as the S&P 500, and I would say this is probably the most important reason is that they lack emotional control, and they can be hindered in this control in a variety of ways. So as we talk about emotional control, as I've reiterated, it's the number one reason people fail to underperform. It's the number one reason people underperform. As we know, people do panic during drawdowns. They sell, they sell at the bottom, and they also chase performance when everything's already priced in. And a lot of people, they expect to buy low and sell high, but in reality, they end up buying high and selling low, which is pretty funny. And at the end of the day, we do all have our biases. And you might be thinking, well, this sounds pretty intuitive. You know, we shouldn't panic during sell downs. and we shouldn't sell when it looks pretty bad. We already know this from Finance 101 to handle all this emotional control. But if we take a look at this, we're not perfect beings and we're not 100% rational all the time. We do have our biases. And an analogy to this would be like here's an example of how many times you reach for the snack bag or you reach for the candy when you know you weren't supposed to eat it. And this can also be turned into investments. It's a lack of emotional control as we're just not perfect beings. And one more point I would say about this is that investing, we need to have a long-term mindset. And the way I would describe this is it's not about brilliant moves or making short-term profit, but it's about avoiding the harsh mistakes that will cost us over time. So we really need to avoid the bad decisions that will create blunders, such as um, such as buying stocks that are way too hyped up or selling when it's really not the right time. So the second reason active investors fail to overperform the market or even match the performance is that everything is already priced in. So how many times have you looked at a stock and thought, well, I'm sitting on a gold mine. This is going to appreciate really high in the next year or in the next month. Well, if we think about it, there are a lot of competitive investors in the world. As a thought exercise, there are 330 million people in the United States right now. And let's say your financial knowledge is the top 1% of those people. So if we chalk it down, 1% of 330 million is still 3.3 million people. And you're still competing against a large majority, not a large majority, sorry. You're still competing against a large sample of people that also have top 1% knowledge. So again, is your idea really unique? And most things are already priced in. Second, the markets are forward-looking, meaning they capture expectations and not what's already happened. So if people are expecting the price to appreciate, then it's already going to be priced in. So therefore, this actually leads to capital gains potential diminishing pretty quickly, and your window of opportunity is pretty limited. And now moving on. The third reason I would say is too much complexity in strategy and analysis. And the main takeaway from this is that more analysis really doesn't lead to better results. And this sounds really counterintuitive. However, let me explain. Smart investors, they love complexity. So they love their detailed models, their multi-factor frameworks, their hedging strategies, etc. And this does feel like a great sign of a good investor. You know, they know all the strategies, they know all the terms, all the jargon, and they know essentially the ins and outs of the financial markets. However, if we keep adding complexity to our decisions, we make more assumptions and there's more points of failure because the more decisions we have to make, the more potential it is for those decisions to be wrong. And when you have a whole bunch of wrong decisions, well, that's not good. So, as I've said before, more analysis doesn't lead to better results. So we really have to know the cutoff point on when to stop analyzing and just take action. As overanalysis it can really be the death of your investment decisions. An analogy I like to put into this is when a student is studying for an exam and they have really complex notes, they're annotated, they're long, and they're pretty complex. Um, you know, it really doesn't matter at the end of the day whether those notes on paper look pretty good, but it matters whether you've stored it all in your brain and you're making the right decisions on the exam. So that's how I would see that. And then finally, the last reason why active investors underperform is indexes actually have a numerous amount of advantages, especially the structural advantages that they have. So the main thing that they have is there's no real emotional element. They don't panic, they don't overtrade, chase narratives, and there's no ego involved. And they automatically just hold the winners, remove losers, and then operate at extremely low cost. Altogether, this actually captures long-term economic growth without behavioral mistakes that humans make. And also, to sum it all up, there are rule-based systems with zero emotion that these indexes have, as opposed to active decisions made by real humans. So now that we know the reasons why most investors fail to outperform the market, we ask ourselves, how can we actually beat the market? So for me personally, well, I don't know, because if I really knew, I would keep it to myself. And also, nobody really knows. Finance, we'll never really figure out finance in general. It's all about fitting in the individual puzzle pieces that we've already learned, but we'll never get close to truly figuring out the full puzzle. Therefore, I do make a recommendation to most people that they should just invest in the S&P 500 and call it a day. So whatever money you make from your wages or whatever your side hustles are, if you have a business, I would say take a percentage of that and just invest it in the S&P 500 for maximum expected value on return, because chances are you're not going to outperform the market. And this is going to lead to the most gains that you can get over time. However, if you are that person that wants to challenge the market, I would say that we should have some considerations before actually attempting it. So first would be the opportunity cost. You know, I think the biggest one would be where are you at in life, essentially? So if you're a young person who has barely any expenses, is living at home, and doesn't have any sort of substantial obligations, then I would say challenging the market is a pretty good idea if you want to do that, because there's really no repercussions if you lose all your money, if you think about it. You can just bounce back as you progress in life. However, if you're an older person or you're someone who has a lot of obligation, challenging the market might not be the best idea, because you might be affecting other people, or you might have such significant obligations that the risk just isn't worth it. The juice isn't worth the squeeze in this case. Secondly, emotional control. I want to tie back into this. Remember to keep a cool head. Don't let the market get the best of you. Be rational as much as you can, and this will lead to the most good decisions over time. You won't make 100% good decisions, but this improves the expected value that you will. So remember, look at the evidence, not just the hype of the market, and just make the best decision based on that. Third, note, I wanted to talk about the external locus of control. So, as I said before, you're not going to get 100% accuracy in the markets. N Not all of your decisions are going to be good. And some of that just isn't within your control. I would say this. I would say 30% of investments are great without a reasonable doubt. 40% is actually within your control, and 30% you'll lose no matter what. So just knowing that there's an external locus of control in some scenarios should give you a little bit of peace of mind. And then the fourth thing I would say is market responsiveness is what matters. So if your strategy actually works, then the market will respond to you and it will reward you effectively. But if it doesn't work, then the market will tell you that it won't work if you and you're going to underperform. So if it doesn't work, maybe consider going back to the drawing board and see if there are any new strategies that you can implement. And finally, the fifth thing is to just have fun with investing in general. I know that's not a really easy thing to say because we're dealing with money here, but at the end of the day, if you're having fun and keeping a cool head, this might actually lead to more decisions that are good, that are being made, rather than you losing your cool, getting tilted, and things of that nature, which can actually lead to impaired emotional control and overall just leading to poorer decisions. So if you really want to challenge the market, I would say just take into consideration all of these things. And thanks for listening. If you do attempt to challenge the market, please, put it in the comments or something like that, whether you succeeded or not. Success stories are always cool. And yes, thank you.